Hello and welcome. Today, we're diving into a concept that's really the cornerstone of the entire audit profession: materiality. Hey, a huge welcome to everyone watching. Whether you're a student just starting out, a new auditor in your first year, or even a seasoned pro looking for a refresher, it's awesome to have you here at the Audit Guidebook. Just so you know, this explainer is a key piece of Module 2 in our Practical Guide to Audit series. So thanks for joining in. Just think about it for a second, right? A company can have millions, sometimes billions of transactions. In that massive ocean of data, how on earth do auditors figure out where to focus? How do they separate what's just noise from what really matters? Well, that's exactly what we're going to break down today. First, we'll ask what truly matters. Then, we'll get into the definition of audit materiality, check out the auditor's toolkit, see how it works in action, and finally talk about why it's really an art of professional judgment. So the answer to that huge question lies in a concept that acts as the auditor's most essential filter. It's the one thing that lets them hone in on what could actually change a user's decision. And that concept is called materiality. All right, let's get right into it and start with the official definition. Getting this right is absolutely fundamental because materiality, it's the very foundation of any good, effective audit. Okay, so if you crack open the auditing standards, here's what you'll find. Materiality is the magnitude of an omission or misstatement in financial information that could influence the economic decisions of users. So it's all about the size and the nature of an error and the impact it could have. But let's be real, that's a bit of a mouthful. So let's break it down in much simpler terms. Basically, if an error, whether it's something left out or a flat-out mistake, is big enough to make someone, like an investor or a bank, change their mind about the company, then boom, it's material. Simple as that. And, this isn't just some abstract theory. It has a super practical purpose. First off, it lets auditors focus their energy on the high-risk spots that really matter. Second, when they do find mistakes, it gives them a framework to figure out how bad it is. And finally, it pretty much guides the whole audit, from day one of planning right up to the final report. Okay, so the big question is, how do auditors actually figure this stuff out? It's not like they just pull a single number out of thin air. It's more like they have a whole toolkit with different levels and factors that all rely on their professional judgment. So inside this toolkit, you've got three main levels. You start with planning materiality, which is the big picture threshold for the entire set of financial statements. Then you set performance materiality, which is a lower number. This gives auditors a buffer, so a bunch of small, uncorrected errors don't sneak past and add up to a big problem. And lastly, you have a threshold for what's clearly trivial, basically the tiny stuff that's so small it's not even worth tracking. But here's the kicker. It's not just a math problem. The size of the number is just one piece of the puzzle. The nature of the item is often way more important. For example, a tiny error that's due to fraud is a much bigger deal than a huge error that was just a simple mistake. Why? Think about it. Fraud points to a massive problem with integrity and internal controls, right? That's way more serious. Auditors also have to think about the company's specific situation and other qualitative things, like whether a small error could cause the company to violate a loan agreement. All right, so we've got the theory down, we've looked at the toolkit. Now let's see how this all plays out in the real world, from the moment an audit starts to the day the report is signed. So right at the beginning, in the planning stage, materiality helps auditors zero in on the big, important accounts they need to test. Then, when they're actually testing things, it dictates how much work they have to do, like how many invoices they need to look at. And at the very end, they gather up all the little misstatements they found, add them all up, and stack them against that materiality threshold to decide on their final audit opinion. And this leads us to what I think is the most important part of this whole discussion. Because while there are benchmarks and calculations, at the end of the day, using materiality is more of an art than a science. It really comes down to professional judgment. This right here just says it all, doesn't it? It's never, ever just about plugging numbers into a formula. An experienced auditor has to use everything they know about the business, the industry, and the current situation to make the right call. For instance, a small dollar error that causes a company to miss its earnings forecast or turn a profit into a loss could be massively material. Context is everything. So let's wrap this up. What's the bottom line? Materiality is that powerful tool that helps auditors cut through all the complexity. It lets them separate the stuff that's truly significant from the stuff that's, well, trivial. It ensures the audit is sharp, efficient, and laser-focused on what actually matters to the people relying on those financial statements. So the next time you see an audit report, take a second to remember all the invisible judgments that went into making it. That whole complex process started with this one powerful concept, materiality. If you found this helpful, do us a huge favor and hit that like button, and definitely subscribe to the Audit Guidebook for more. Thanks so much for watching.